The following is a simple illustration of the recording process. Let's assume we have the following beginning trial balance for a given accounting period. Notice that the balance sheet accounts have a balance before any of the current period transactions have been recorded. These balances remain from prior periods. Here is what the ledger would look like at the beginning of the period. On the ledger, each of the accounts shown will include the beginning balance from prior periods. Let's assume that during the current period, the following transactions occurred. Here is a demonstration of the recording process as it is completed for the first transaction. The first step of the recording process is transaction analysis. These are the steps of transaction analysis. From our analysis, we determined that there are 4 accounts affected by the first transaction. The affected accounts are the cash account, the inventory account, the sales revenue account, and the cost of goods sold expense account. The cash account increases by 100. The sales revenue account also increases by 100. The inventory account decreases by 50, and finally, the cost of goods sold expense increases by 50. Now that we have analyzed the transaction and its effects on the accounts, the next step is to journalize this transaction. This particular transaction will require a compound journal entry, which is to say that more than 2 accounts are affected. The following journal entry is made within the journal. There is a debit to the cash account for 100 and a debit to the cost of goods sold expense account for 50. Then there is a credit to the sales revenue account for 100 and a credit to the inventory account for 50. These 4 lines represent the journal entry for the first transaction. Now that journalizing is complete for this transaction, we can post it to the ledger. We will increase the cash account by 100 by posting a debit of 100. Because the cash account had a beginning balance of 100, posting this entry will increase the balance of the cash account to 200. We will increase the sales revenue account by 100 by posting a credit of 100. The balance of the sales revenue account is now 100. We will increase the cost of goods sold expense account by 50 by posting a debit of 50. The balance of the cost of goods sold expense account is now 50. We will decrease the inventory account by 50 by posting a credit of 50. The balance of the inventory account is now 0. Now that we have posted the journal entry for the first transaction to the ledger, the account balances can be updated on the trial balance. The trial balance as seen here now reflects all of the account balances after the first transaction has been recorded. If you would like to see the recording process illustrated for the remaining transactions of this example, proceed to the next video in the playlist.